We talk about this idea of what could be a major structural shift in the way that we view developed economies, emerging economies, and of course how you invest around that. Is this EM story that a lot of people have talking about, is that a short-term cyclical story or a longer-term structural trend?
I think we're in the midst of a sea change in global markets. For the past 2 to 3 decades, we have seen the safe haven status of developed markets as a tenant across fixed income markets. And that was really warranted. We saw, strong growth in developed markets. We saw a very, benign fiscal picture with, managed fiscal deficits, low debt loads. But then we went into the global financial crisis. Interest rates were lowered. Demands on governments increased. And, some of those, structural, benefits that developed markets had experienced, for these past several decades started to erode away. On the other hand, emerging markets, we've always put under, more scrutiny when it comes to the outlook for, the debt trajectory, when it, comes to inflation, growth, and then specifically, the fiscal balance and the way that the government, prioritizes their spending versus revenues that they take in. And that is important for us as investors because as we lend money, whether it's to a company or to a country in this case, we need to know that we're going to get paid back and paid back, in the real terms, inflation-adjusted terms, pari passu to the risk that that we're taking.
But I'm curious about the fiscal side. I mean, we've seen, of course, obviously the story in developed markets. I mean, obviously the own goal that we saw with the UK and the gilt crisis, France, whatever the heck's going on with our interest payments here in the U.S. What happened where you started to see Brazil and Indonesia and all these EM countries somehow get their fiscal house in order? Was that just by accident?
Well, no. Yeah. Obviously, emerging markets have a risk premium for a reason. That, for decades, the fiscal was, a big question. The reason for that was the, populace, the electorate, the people in the emerging markets demanded, fiscal spending and, government handouts, from their governments. And what that led to were a series of, in the late 1990s, we had debt crises and default crises that needed to be addressed with having the IMF and the World Bank come in. And we've seen a series of packages, over the past few decades that have led to interactions between, policymakers in emerging markets and, the World Bank and IMF officials to improve, the fiscal policy, the fiscal trajectory, across many of the large emerging markets to, where we are today, where, we look at when excluding interest payments, if you just look at the primary balance, the fiscal balance excluding interest payments for many emerging markets, a lot of them are in balance. When we look at the debt trajectories, a lot of them are less than 100% debt to GDP. Let's just juxtaposition that against what's happened over the past couple of decades in developed markets where electorates now have demanded more social safety nets from their governments, increased fiscal spending, across developed markets from the U.S. to France to Italy to the U.K. to Japan, have eroded many of, those countries' fiscal profiles, increased their debt loads, to just around or above 100% debt to GDP. And I think when we take a look at the forward trajectory of, the way that you can either deal with the fiscal balance of increasing revenues or you can pull back some of that spending. Pulling back spending is very difficult, especially when you have, voting that becomes more and more polarized. And that historically has been a characteristic of emerging markets, and we've had to price that risk appropriately. We've had to ask for additional term premium when we lend money into emerging markets, which we haven't had to ask in many developed markets. When we look at the past decade, from the UK to France to Japan, and now we think increasingly, these concerns are coming to the U.S. as well.
Right.
We're going to have to start pricing that in.
Well, Bill, let's talk a little bit about the U.S. because I'm taking a look at, one of your recent articles. You titled it Powell's parting gift. And basically you write that by normalizing on-the-record disagreement at the monetary policy table, that Chair Powell has probably diluted the power of the position. In other words, he has likely created an institutional check on his successor, Kevin Warsh. And I'd love to expand on that a little bit and how that plays out, because you said, right before we started that perhaps you see the Fed moving more towards a Bank of England type model.
Yeah. So historically, the Fed chairman has wielded a lot of, of power in being able to get consensus in meetings and have very little dissent in voting to decisions that are made. And, that power, I think comes with, both benefits but risks as well. If we have, like we are seeing in the U.S., questions rising about credibility, transparency, in, Fed decision making. I think one of the ways that you can counteract some of that question or that, risk that the market's assessing is to reduce that, soft power that the chairman has historically had and opening up the, voting to become much more independent. Because really, what do we want in our central bank? We want an independent institution that's focused on price stability and focused on, maintaining full employment, but really control of markets. If market participants don't believe that the Fed is acting uniquely in those interests, that's when you can have a lot of unintended consequences, increased volatility, in markets. And I think Chair Powell recognized that, the risks that the market was losing this confidence in the Fed were starting to grow. So when President Trump put Steve Myron on the Fed, I thought it was very interesting. Obviously, Steve Myron was going to start, voting for cuts against what the majority of the FOMC wanted. And, that was to be expected.
Right.
But when we got to the end of last year, I found it very interesting that Powell allowed dissents for, Goolsbee decided that he wanted to dissent against a cut in December of last year.
Right.
So kind of normalizing, the dissents not only to, the direction that the president wanted, but also, the opposite direction as well.
Yeah.
And that I think what that has done is by kind of taking that soft power away, it's actually increased the probability that markets will still have that faith in the Fed.
Well, I am curious. I mean, you mentioned that this could breed an environment of more volatility, especially, if we enter into an environment where it's really, the economic backdrop doesn't point in one direction or another. It's something that could be debated. And, you make a good point that the chair is just one of 12 votes, but really that's been kind of symbolic over the past couple of years. But where would you expect to see that volatility expressed if we do enter a Fed that does normalize dissents more?
Well, I think, I think the biggest concern is, we're entering, an environment where the macro is kind of turning against us. We have this war in the Middle East that, has pushed energy prices up and pushed, an inflation shock into the system. The longer this inflation shock lasts, the more that we have a question on the growth outlook. On the Fed side, the last thing that we need is for credibility to be lost. We saw that around 2015 when, there was concern about, Fed funds, remaining within the corridor and actually, popping out. When if credibility is lost in the Fed, the ability for the Fed to both maintain inflation expectations on, a contained trajectory and lower interest rates when needed to offset slowing growth, that could be taken away. And that would manifest itself into, increased volatility in markets and, potentially bad growth outcomes. The mechanism for which that is done is via term premium.
Right.
So if we think that Fed credibility is lost, interest rates are going to rise.
Okay.
We've already had an inflation shock that has put upward pressure on interest rates following this invasion in Iran.
Right.
We have now questions about the fiscal, which could put upward pressure, especially on the long end of the curve. And if we have a Fed where credibility becomes a question, that would be a third independent variable that would then potentially put upward pressure on interest rates.
Is there a risk, though, for the Treasury market in there? And I don't mean necessarily in terms of rates, but I mean in terms of demand, particularly coming from foreign buyers.
Yeah. So, the foreign buyer, situation is that there has been, more tepid buying in the long end, of the U.S. Treasury curve, but they've been, looking at allocating capital elsewhere. I tend to think that that is a smart, decision at the moment. We're currently, for all the reasons that I just listed, cautious on placing money, in the back end of the U.S. Treasury curve. We prefer to place, our investor capital, more in the belly of the interest rate curve for the reasons that I discussed. And a lot of foreign capital, is doing the same. One thing that, we have seen is, again, we're kind of keeping, I'm going to come back to this war on Iran. One large, pool of investors, for U.S. Treasuries is central banks. Now that we've had this global volatility shock, central banks are, selling a little bit of their Treasury holdings in order to have, longer-term Treasury holdings in order to have more liquid, cash available for intervention. So
it's a little selling, but it seems like it's multiple banks. I mean, if it was just one or two.
No, it's across the globe. But I think they want to have dry powder just in case, things start to get out of hand. There's been a lot of discussion in, Asia. Asia, historically, the institutional investors have been large buyers of, treasuries, especially in Japan. And now that you see, JGB yields having backed up, to their current levels, on a hedged basis, there's the discussion of will, Japanese lifers and Japanese banks choose to buy JGBs instead of treasuries going forward. We continue to see JGB yields increase. Why? Because they have the same fiscal pressures, that we have. So right now, I think that allocation will still be in the U.S. If the U.S. loses that fiscal anchor and that credibility anchor in the Fed, and we start to see yields rise because of that reason, I think you could get more of an allocation away from the U.S., and that could cause, knock-on problems. So we're not seeing, to answer your question directly, we're not seeing very large movements on the, as far as the foreign investor demand away from U.S. Treasuries. We're seeing it on the margin. The potential is that, over time, with these risks that are building, that could increase.
Well, Bill, in the minute or so we have left with you, I do want to bring the dollar into this conversation, because you think about central banks buying fewer treasuries, buying a lot of gold, really, in recent years. It sort of fits into that de-dollarization narrative. And I just wonder, how you, as a firm, are viewing the dollar right now, especially in light of the recent declines.
We think that the dollar is now in a structural downward trend. Very near term, while we have the Iran situation going on, I think the dollar is relatively range-bound. But the change in U.S. policy, whether it's trade policy or foreign policy being the biggest surprise this year in the fact that the U.S. has switched from what we thought would be an America First isolationist policy to now an interventionist policy, not only engaging in kinetic activity in Iran, but also Venezuela. I think that only adds to global concern about the U.S. dollar being the reserve currency and the store of value. I think that the best way to play this is through EM local, the EM local trade, whether it's EMFX or EM local rates. And, if we're in an environment today where equity valuations are very high, credit spreads are very tight, the last place of value or, place that you can easily pick up value in is EM local, where you have high real yields and still long-term cheap currencies.